framework for the preparation and presentation of the financial statements was issued. However, in past several years, International Accounting Standard Board made amendments to it, and the new, although unfinished, However, in past several years, International Accounting Standard Board made amendments to it, and the new, although unfinished framework was issued in September 2010 with the new name, the Conceptual Framework for Financial Reporting. It is still in progress, as you can see. Current framework has 4 chapters. Chapter 1 and Chapter 3 are new, issued in September 2010. Chapter 2 is empty. It will deal with the concept of the reporting entity and will be issued later. Chapter 4 comes from older 1989 framework, and individual parts will be replaced later on. So let's look what's in it. Chapter 1 is about objective of the general purpose financial reporting, which is to provide financial information about the reporting entity that will help to many different parties such as investors, lenders, regulators, or other. What financial information shall be reported and in what statement? Entities' economic resources and claims against the resources are usually presented in the statement of financial position. Changes in economic resources and claims resulting from economic performance are presented in the statement of comprehensive income. Changes in entities' cash flows are presented in the statement of cash flows. And changes in economic resources and claims not resulting from economic performance are presented in the statement of changes in equity, for example, issue of new shares. The statements are listed in IAS 1, but here we try to link them directly to framework. Chapter 2 is currently empty and will be added later. It will discuss the concept of the reporting entity. Chapter 3 discusses qualitative characteristics of the financial information so that the information is really useful for its users. There are 2 types of characteristics, fundamental and enhancing. The first fundamental characteristic is relevance. Relevant financial information is capable of making a difference in the decisions made by users. Here, the concept of materiality applies. Materiality is an entity-specific aspect of relevance based on the nature or magnitude or both of the items to which the information relates in the context of an individual entity's financial report. So, in other words, it's something like significance. The second fundamental characteristic is faithful representation. Financial information must not only be relevant, but must faithfully represent what it aims to represent. Therefore, it must be complete, neutral, and free from error. Financial information shall have both fundamental characteristics. Enhancing characteristics are comparability, so information should be comparable between different entities or time periods. Then verifiability, independent and knowledgeable observers are able to verify the information. Timeliness, information is available in time to influence the decisions of users. And understandability, information shall be classified, presented clearly and concisely. Enhancing characteristics shall be applied to the maximum possible extent. Now we come to Chapter 4 that contains the remaining text from older framework. This text will be replaced by the new one later on, so let's go through it. Underlying assumption for the preparation of financial statements is going concern. It means that an entity will continue its operations in the foreseeable future, basically 12 months, and will not liquidate or materially curtail operations. The elements of the financial statements are broad classes into which the financial events or transactions and their effects are grouped. The elements directly related to the entity's financial position are assets, liabilities, and equity, which is the residual interest in the assets of an entity after deducting all its liabilities. The elements directly related to entities' financial performance are income, both revenue and gains, expenses, both losses and expenses from ordinary activities. Recognition of the elements of financial statements means simply showing these items in the statement of financial position or balance sheet before or in other statement. Any element that we have just talked about shall be recognized when fulfills the following criteria. It is probable that any future economic benefit associated with the item will flow to or from the entity, and the item's cost or value measured with reliability. While recognition means when or whether to recognize, measurement means in what amount the recognized asset, liability, piece of equity, income, or expense. There are several ways used to measure the items in the financial statements, such as historical cost or current cost, net realizable value, or present value. The most common one is historical cost, but also other bases are used in combination. Finally, IFRS framework explains 2 concepts of capital and capital maintenance. Under a financial concept of capital, such as invested money or invested purchasing power, capital is synonymous with the net assets or equity of an entity. Under a physical concept of capital, such as operating capability, capital is regarded as the productive capacity of the entity based on, for example, units of output per day. Based on these concepts, capital maintenance is derived, and an entity determines basis of measurement and accounting model used in preparation of the financial statements. So, that's the conceptual framework at a